What if your portfolio paid you $9,000 every single month without you ever having to sell a single share? Imagine waking up on the first of the month and seeing a deposit that covers your mortgage, your car payment, your travel, and your groceries, all while your initial investment stays exactly where it is. For most people, this sounds like a pipe dream or a lottery win, but for a growing community of smart investors, this is just a standard Tuesday. Most people approach income investing completely wrong. They chase the wrong stocks, they ignore the tax implications, and they end up earning half of what they could with the same amount of money. They get trapped in the cycle of selling off their winners just to pay the bills, which effectively kills their long-term wealth. Today, I am going to show you how to break that cycle. We are diving deep into 3 powerful strategies to realistically hit $9,000 a month using monthly dividend ETFs. Now, before we get into the heavy lifting, we need a serious reality check. This is not a get-rich-quick plan. If you are looking for a way to turn $100 into $10,000 by next Friday, you are in the wrong place. Real wealth is built through math, discipline, and time. The core math of dividend investing is actually quite simple. Your monthly income is the result of your total capital multiplied by your dividend yield. If you want to earn $8,300 to $9,000 every month, you're looking at an annual goal of roughly $100,000 to $108,000 in passive income. If you have a portfolio with a 10% average yield, you would need about $1 million to generate that $100,000 a year. That might sound like a huge number, but depending on the strategy you choose, you might need way less capital than you think, or you might choose to take on more risk to get there faster. The key is understanding that every dollar you invest is a tiny employee working 24/7 to bring you more money to hit that $9,000 monthly target, which totals $108,000 per year. We have to be incredibly strategic. You can't just throw money at random stocks and hope for the best. We are going to break this down into 3 distinct paths. First is the high yield strategy, which is the fastest path to our goal, but comes with the most volatility. Second is the balanced strategy, which offers a middle ground of safety and growth. Third is the growth to income strategy, which is designed for those who are starting from almost nothing and need to build a massive nest egg before flipping the switch to income. Each of these fits a different type of investor depending on your age, your current bank balance, and your tolerance for seeing your account balance fluctuate. Strategy number 1 is the high yield income path. This is the fastest way to hit $9,000 a month because it focuses on monthly dividend ETFs that prioritize immediate cash flow over everything else. In this category, we aren't looking at traditional companies like Coca-Cola or Apple. Instead, we are looking at sophisticated financial instruments like covered call ETFs and income-focused derivative funds. These funds generate cash by selling options on their holdings, which translates into massive monthly distributions for you. We are talking about yield ranges in the 10% to 15% neighborhood. At a 12% yield, you would only need about $900,000 to hit your $9,000 monthly goal. Compared to the millions required by traditional saving accounts, this is a shortcut. The pros are obvious: fast income and immediate life-changing cash flow. However, there is a hidden problem most people ignore. These funds often have lower capital growth, meaning while they pay you today, the actual price of the ETF might stay flat or even decline over time. You are essentially trading future growth for a massive check right now. If that sounds a bit too risky for you, then strategy number 2, the balanced income strategy, might be your smart middle ground. This strategy blends moderate yield ETFs with funds that offer some price appreciation. Instead of reaching for 15% yields, we aim for a more sustainable 5% to 8% range. To hit $9,000 a month at a 6% yield, you would need a capital base of roughly $1.8 million. While that is a higher mountain to climb, the foundation is much stronger. In this strategy, you would look for dividend growth ETFs that hold companies with a history of increasing their payouts every year. These funds are more stable, they recover faster during market downturns, and they offer a growing stream of passive income that helps you stay ahead of inflation. You aren't just getting a check, you are getting a check that grows every year without you having to add another penny. It's about building a fortress that provides both stability and income. But what if you don't have $1 million sitting in a bank account yet? This is where strategy number 3, the growth to income transition, changes everything. This is how normal people actually reach $9,000 a month. Instead of starting with dividend funds, you spend phase 1 of your life focused on pure growth ETFs. These are funds that might only pay a tiny 1% dividend but grow in value by 10% 10% to 15% annually. You spend 10, 15, or 20 years letting the power of compounding turn your modest monthly contributions into a multi-million-dollar portfolio. Then once you hit your freedom number, you rotate that capital into the dividend ETFs we discussed in strategies 1 and 2. By reinvesting your dividends early on and focusing on total return, you build the engine first, then you turn on the fuel. This is the path for the 18 to 35-year-olds who want to ensure their future self lives in total financial abundance. Let's look at a side-by-side comparison to help you decide which moment you are in. Strategy 1 is for the person who needs the money now and has a decent amount of capital but a shorter time horizon. It's high speed, high risk. Strategy 2 is for the investor who wants a set it and forget it lifestyle, valuing peace of mind over maximum yield. Strategy 3 is for the builder, the person who is playing the long game and wants the biggest possible payout at the end. Which one fits your situation right now? Are you the person who needs cash today or the person who is building a legacy for tomorrow? Comment 1 for high yield, 2 for balanced, or 3 for growth to income below. I want to see where this community stands. Now, regardless of the strategy you pick, there are some massive mistakes that can absolutely destroy your progress. The first big mistake is chasing yield blindly. Just because an ETF offers a 20% yield doesn't mean it's a good investment. Often, a yield that high is a warning sign that the underlying assets are losing value. You don't want to get a $9,000 check if your portfolio dropped by $20,000 to give it to you. The second mistake is ignoring total return. Always look at the share price and the dividend together. If the share price is constantly falling, your income will eventually fall too. Third is the mistake of not reinvesting your dividends during the building phase. If you spend your dividends when your portfolio is small, you're killing the compounding effect before it can even start. Finally, avoid unrealistic expectations. You won't hit $9,000 a month overnight. This one mistake alone, impatience, can cost you years of progress because it leads to jumping from one hot investment to another. You need a straightforward, actionable plan to do this. First, choose a plan based on your age and capital. Choose the one that fits your timeline instead of all 3. Second, choose 2 to 4 high-quality ETFs. Overcomplicating your portfolio makes tracking difficult. Step 3, automate monthly investing. Set it up to automatically invest part of your paycheck in your monthly dividend ETFs before you spend it. Step 4, set your account to DRIP or dividend reinvestment plan if you don't need the income yet. This automatically buys more shares each month, increasing your payout the following month. Starting with $100 a month works if you start. It takes persistence to make dividend investment math work for everyone. Mastering these strategies changes your money outlook. You see your bank balance as an income-producing machine instead of a static quantity. Think about the freedom of living off your assets, not your labor. Reclaim your time this way. This ensures that your 18 to 50-year-old self works for a goal, not just a paycheck. Only if you start today may your future self travel and spend time with whomever they want on dividends. Waiting for the perfect investment time delays your independence. The $9,000 a month promise is mathematically guaranteed for those who stick to a strategy. Monthly dividend ETFs are the tool. Discipline is the engine. Start developing your income empire now and let your portfolio carry you for life.